I think the reason like just SIMD-228 was so controversial is that it is one of the first changes that I can think of that is not just purely technical, but it's also very economic in nature.
Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed.
Hey guys, welcome back to another episode of 0x Research. Before we get into the show today, as we've been doing for the past few weeks, I want to give one last shout out to DAS. It's coming to New York. It's going to be next week. Both Carlos and Mark here on the call from the research team will be there, as well as some other folks from the team and some great speakers and members from around the industry. So if you want to get your tickets, it's kind of your last chance going into next week. Use code 0x10 at the link in the description, grab some tickets, and hopefully we'll see you guys at DAS next week. All right, let's dive into it today. Like I said, Carlos and Mark here with me today. Couple of relatively big announcements. I think there's sort of maybe a positive and a negative to the announcement around the strategic Bitcoin reserve that came out over this past week. Kind of terming it the seized Bitcoin reserve. It still fits the SBR acronym there, but I think the market was maybe a little overexcited about what this announcement could be. There may have been like an implicit expectation that the U.S. government would be buying Bitcoin on some cadence, like the kind of Senator Lummis has alluded to with her kind of ideal of getting to 1 million units of Bitcoin. But either way, executive order from Trump came out. There is this establishment of the strategic Bitcoin reserve and the United States digital asset stockpile. We talked a little bit previously about this stockpile / reserve of other assets as well. It seems largely that the text of this and the intention here is specifically to just not sell, leading cryptocurrencies that are seized from illicit activities, really. And that it seems like that may have been a disappointment for the general market that was maybe expecting more. What are your guys' high level thoughts here? Is this were we expecting this? Is this counter to any thoughts that we had, or is this more or less than we expected this soon?
I think it was largely expected. I like the fact that they highlighted Bitcoin this time around and they didn't just leave it at digital asset stockpile. I think it's good that Bitcoin will have a preferential spot, if you will, on the reserve. And I think at the end of the day, it will be the main focus, which is the way it should have been from the start. I agree with you. I think they will most likely just not sell the assets that they have seized in the past from Silk Road and other hacks. But yeah, it could be I wouldn't rule out some states buying Bitcoin in the next year or so, or some changes that allows the government to actually get some buy orders in. But at this stage, it seems highly unlikely.
Yeah, I agree. I think it was largely expected, at least for us internally. I was just hoping that the market was also pricing in a nothing burger. I mean, most of these kind of White House summits are, sorry, and not just crypto related. So, I mean, I think it's big in the sense that, if we look 6 months ago, 5 months ago, we wouldn't have imagined crypto being an agenda in the White House. So I think from that lens, it's really good. Not selling the Bitcoin that's already in possession. Okay, at least there's no sell pressure there. I think that's a good thing. I'm also happy that David Sachs kind of walked back on Trump's post about the ADA XRP. He just said, Trump just tweeted out the 5 largest by market cap. Don't read too much into it. And I think I'm glad to see a little bit more formalization around why that was remarked on. So overall, I think the markets pulled back slightly. I think there was a little bit of rumors of maybe taxes, a reduction on taxes for crypto long-term gains, and that didn't materialize. So there was a slight pullback, but I think it was largely expected, and it went the way that I think we largely thought it would.
How do we feel about the outlook for like Bitcoin from here? And I know, Mark, you've done a recent monthly report or monthly note on Bitcoin in general and the network. Like, what are our thoughts going forward? Carlos, you mentioned, there are some states that are pushing bills through, local state house and senates at the moment, to formalize some kind of like state level Bitcoin investments. But uh, I guess going forward, it's a bit different now. Like, I think prior to this event, there was some like hopium still left in a lot of, maybe retail's mind of, hey, the government's going to buy our bags. With that out of the way, what's sort of next, or where should people be looking, or what should we be thinking about going forward?
I think something that's underappreciated is BlackRock adding Bitcoin to their model portfolio. And I think they put a 2% allocation, which means that not just from the pure Bitcoin ETFs, just people, just like hedge funds or maybe pension funds and traditional advisors choosing their own allocation, but other ETFs that use BlackRock's model portfolio as a sort of index or benchmark will start to have this as an asset allocation in their portfolio long term. It was a recent change. I think it was maybe last month. And it's going to take, for chief investment officers and portfolio managers, it's going to take them some while to do the Sharpe ratio analysis and whatever else their internal processes are to include this into their structures and start to advise it to clients. But I think that is another structural tailwind for Bitcoin moving forward. And if we were in a different type of market, that would have been probably all over the Twitter timeline and social media. But now it doesn't get a peep out of anybody. But again, I think it's just another slow increment towards just mainstream adoption of Bitcoin and potentially other assets as well.
Yeah, it's a great call out. I want to share this chart you pulled for the recent report on Bitcoin, but also highlighting that the IBIT ETF has seen the greatest amount of flows retained as well. And maybe that has something to do with just their general the investors that are using this fund, or how they're treating it or thinking about it going forward. But I think you make a good point just generally in terms of the long-term view here. It seems things are relatively positive, but it's just that the short-term market action has left some people in the crowds a little bit confused as to what's going on right now.
Yeah, definitely. And then, I mean, with BlackRock's retention, I mean, I'm not 100% certain, but anecdotally, when I see these 13F filings reports come out every quarter, which is any financial institution that has over $100 million of an asset needs to report it in these filings. And anecdotally, I just see them as Goldman Sachs and these other large financial institutions. So I think it's probably, like you said, the holder base, the buyer base of these assets is why BlackRock has such a higher retention rate compared to others. I mean, that being said, last month wasn't the best for Bitcoin flows in general. I think we saw like $3.6 billion of outflows, and BlackRock contributed to $775 million of those. So wasn't strong from them either. Grayscale continues to bleed. Like, I don't know when we're going to get this Grayscale overhang out and done with. I mean, at this point, I think them launching their fund might have been a net negative for the industry if it wasn't for that little ETF transition. But I mean, yeah, we see it here, February, one of the worst month by far, hands down, no question about it. And when we normally have, on an average, on a monthly basis, structural inflows coming in from the BTFs, and then last month, February, we had negative price returns. Then the ETF outflows did not help with that, right? And so we saw one of Bitcoin's largest drawdowns for the past maybe over a year and a half. And I don't know if the ETF flows lead the price action or vice versa. It's really hard to say. There's some modeling to be done on that. But this chart here that we have up, it says February, so maybe not up to date, but I think the drawdown was close to 28%, which seems for some reason to be like around the max drawdown Bitcoin is experiencing. And I thought maybe the flow of ETFs and this new mainstream adoption was helping dampen the volatility of Bitcoin. But even in a month where we had record ETF outflows, it still hasn't drawn down more than 28%. Knock on wood. Hopefully that's it for now. But yeah, it's a fascinating quote unquote cycle thus far for Bitcoin.
Yeah, I largely agree. Like, even if Bitcoin has seen drawdowns, I think it has shown remarkable strength relative to other crypto assets. Like, if you just focus on February performance, Solana like draw down like 18% against Bitcoin, and like it's just like this type of volatility. I think it's normal for a bull market. I think we forget that in 2021, Bitcoin uh, probably had a max drawdown of 50% or something like that, like in the midst of the bull market. And I agree with Mark, like the structural inflows from the ETFs have largely changed that dynamic where we don't see as sharp drawdowns. But I think like it's not something that should like entirely surprise us. And in the past like month or so, we have seen some macro uncertainty, and I think like it's not just Bitcoin that has performed poorly. I think in general risk assets have taken a hit, and you cannot just expect it to be uncorrelated from everything else in the financial system. It's just like the way it is. It's just correlated with global liquidity and the not.
Yeah, I think that's a great call out, Carlos. The Trump admin has been making it very clear, and not to macro LARP too hard on this pod. We try to avoid that usually, but they've been making it pretty clear that they're okay with seeing some volatility in risk assets for the time being to sort of achieve their goals when it comes to rates, yields, and the budget going forward. So that's, I think, essentially what we've been seeing in both equities, and I think Bitcoin and other crypto assets have been hit by that maybe flight away from risk for the time being. So yeah, it's hard to get into a sense of having some sort of bulletproof asset. There's always going to be up and down that comes with things. So it's not too surprising on that side of things. But maybe another. Oh, go ahead, Mark.
No, I was going to say, yeah, since not to be too macro, but since we've had this macro uncertainty, we've definitely seen an increase in the correlations between, Bitcoin and all the other assets. And then it does it put into context, okay, what are we looking forward to? Are we just looking forward to when this, Fed starts to cut interest rates, or are we looking to when tariffs ease down, and you actually, I maybe mentioned things long-term, structural long-term tailwinds. And if I had to like just try and think about it, pull something out, the only catalyst, let's call it that, I can think of is Michael Saylor with his new $21 billion raise with his preferred 8% coupon stock. And if he does succeed with this, and I don't see why he wouldn't, raise $21 billion, if somebody could do it, it's probably Michael Saylor. And from an investor point of view, an 8% coupon, then at probably, and the yield is higher because I think stock STRK, that's what the preferred stock ticker is. It's trading at around like 86, so I think the yield is probably somewhere 9-10%. As an investor, if you can get that kind of dividend yield, plus if Bitcoin does well, it's going to be correlated, and you can get some of the MSTR stock on the convertible, right? Then this can be a pretty welcome backstop for the Bitcoin, and hence the whole crypto industry right now. I mean, for perspective, $21 billion at today's prices is roughly 270,000 Bitcoin. And since the halving, Bitcoin, miners, there's an emission of 164,000 Bitcoin per year. So Michael Saylor will basically buy up the next year and a half supply worth of Bitcoin emissions. And, the speed at which he goes, I assume probably somewhere around 3 months, So if we can get that as some kind of a catalyst, some kind of fire to ignite or reverse the tides, then maybe there is some hope for the industry. But I hate relying so much on Michael Saylor to be buying the dips.
Yeah, I think maybe a way of thinking about it is obviously when Bitcoin is performing well into the upside, it gives him more ammo to sort of keep raising and keep buying and kind of repeat that cycle over and over. To the downside, I don't think he can be so quick about constantly getting fresh new capital in. But to your point, it may have some level of a dampening effect. Whereas on the upside, it probably had a little bit of an amplifying effect to Bitcoin. So, but yeah, I think the big question is just if it continues to the downside or we go sideways for a while, like what's his real ability to kind of continue raising cash and buying more BTC? He's certainly going to be limited to some extent as compared to a few months ago when, price was really up only. But it's a great point. I think a lot of people have been really leaning into how much of an impact do the sailor buys really have on the market? I think, if we look back to 2021, the question was like, how much do stimulus checks have had an impact on the market? And now it's like Michael Saylor is sort of like the stimulus check for Bitcoin almost. This episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger remains the most secure hardware wallet for your crypto and logins, trusted by 7 million users and securing 20% of the world's digital assets. Follow the link in today's show notes to grab your Ledger now. But I guess other relatively big news, I suppose not for a while, but something that's becoming more and more clear is this idea of like the continued shift towards always on global markets that, crypto markets have basically pioneered and been pushing on for the past, 10, 15 years at this point. But we're seeing NASDAQ, they've announced their plans to enable 24-hour trading. It sounds like sometime in 2026. This is, highly dependent on regulatory approval, obviously, as well as some infrastructure upgrades. Maybe that utilizes blockchain technology. Maybe that is just upgrades to the existing system so that clearinghouses and the other intermediary pieces that handle trading and clearing and settlement of different assets can actually work around the clock. But either way, I think we're seeing this trend more and more, especially with coming into this new admin. Some of these legacy institutions, legacy markets, are more open to the idea of round the clock, 24/7, always on markets. I think we've seen examples from Robinhood and even Coinbase trying to push on that front. They've recently announced a U.S. perpetuals sort of release as well. So I guess I'm just curious your guys' thoughts here in terms of like what are the real impacts of this? Do we just expect more and more, like still have the NASDAQ and QQQ and BTC 10-day rolling correlation up? Like, are we just expecting continued convergence of these assets where, today there is still some separation where, the crypto markets and the equities markets, while, risk patterns and liquidity patterns are correlated to an extent, you might have some different like sets of investors. Are we just getting to an eventual point in the future where everything is merged and people are just trading all of this stuff, all in one place or all from one, brokerage or environment?
I think it's an interesting question. Like if you look at crypto, it trades 24/7, 365 days a year. And so by definition, there's no other asset class that incorporates information as fast as crypto. And I think we've seen it time and time again: front run information faster than other markets, react faster than other markets. And if you look at, like, I don't know, equities, they trade like what, 200 days a year. They don't trade 24/7. They trade like in an 8-hour period or something like that. So I think like the move towards 24/7, 365-day trading, it's inevitable. And what I think one of the effects that we'll see is just like uh, every asset class incorporating information as fast as crypto does today, which can add interesting dynamics to like capital markets at a global scale.
Yeah, definitely. I'm looking forward to it because I think, for one, I'm kind of tired of crypto being the only instrument to express your viewpoint after hours or maybe on a weekend, and it gets so volatile. And if there are more traders online, and I'm sorry for them when this happens, your job is going to get a lot harder. But when that happens, there's going to be just generally more liquidity in the market on weekends and other viewpoints. So I think crypto will see more liquidity because traders won't be shutting off on a Friday evening, and there will be multiple things to maybe pair trade as well. But largely, so I think it's going to be good from a volatility perspective because, in the sense of relative comparison, like stocks if when this starts, they're not going to be they're going to be more thinly traded than they are during the weekdays during the 8 hour window, especially during US hours. And if it goes to 24/7 on weekends, it's going to become a lot more volatile as liquidity dries up on those during those after hours, but it's still being traded somewhere. And then that starts to make sharp ratios less appealing in general, starts to make things a little bit riskier. But then it makes crypto less risky in relative comparison because it's been doing this and the volatility for crypto has been coming down. I mean, if you look at it at 2024, Bitcoin was less volatile than 35 stocks in the S&P 500, right? So the largest 500 companies in the US, Bitcoin had less volatility than some of them. And then if you look at like private equity markets, these things tend to have better risk adjusted ratios than public equities. But I think it's really because they're only valued less than once a quarter, right? So it can go up if there was a true market. It can be going up 10% up and down 10% through the entire time, and then it just chooses 1 point on the dot plot on March 31st. So I think this will help with that comparison between the two different markets, and also open up people to having just open up people to having 24/7 trading technologies. Like Robinhood, you can already trade stocks and crypto on the same platform, and with ETFs, you integrate that into whatever ATS provider you're using for the stock brokerage, and then it starts to become very dissimilar, especially if we move past this just memes and speculative phase that we're in, as every new industry is in, and start to look at like fundamental growth and look at them as startups and businesses, but that you can trade in public markets 24/7. Then I start to see like more fundamental driven approaches and more investors coming into the crypto markets as well.
Yeah, I guess also the question is when we'll start to see these stocks like issued on chain directly, because right now we have kind of like this mix and match approach where we have like traditional rails, like, and then on top of that you add like technological, I don't know, like yeah, like just technology to allow for these 24/7 trading, but like in the back end you still have like the old system, so it's not really like completely transformational. I think I'm excited for the time where we issue stocks directly on chain and we have like these native asset issuance, and I'm just not sure if they'll use like their own DLT or they'll use like a public blockchain or of that sort, but that's obviously like something more like in the long term that will than something we'll see right now.
Yeah, great points. I think, Mark, your comments around volatility are probably felt by market participants over the past few months, especially with a lot of like Trump admin announcements on Friday nights, Saturdays, Sunday evenings, DeepSeek over the weekend. I think a lot of that stuff we saw, Bitcoin and crypto assets move to the downside or upside, and then also move when markets opened on Monday morning as well, like alongside equities. So, yeah, I think that's a great point. It'll be interesting to see sort of how the volatility of both markets transform if we get to a place in the future where really all assets are traded round the clock. Big shift in the game. And yeah, like you said, I don't envy any of the traders that then have to monitor things literally 24/7.
Isn't that kind of what we do now?
Yeah, I guess if you're in crypto, you already do that. So I guess maybe they just need to get used to it if everything's going to be tokenized. Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your transactions and assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional passwords and enhancing your digital security. Follow the link into today's show notes to get started with Ledger today. I guess moving on, another thing that I think we're monitoring currently, and I'd love to get some insight from Carlos on, is on Solana. There's been a lot of debate over SIMD-228 and impacts to the chain, impacts to basically yield rates, staking rates, kind of all related. So I would love, Carlos, if you could actually sort of start from like a generalized discussion of why SIMD-228 and walk us through like what it means, potential impacts, and then we can take a look at like what's going on, because there's been some debates and there's actually a vote up now to go through with it or not.
Right. So yeah, basically Solana's inflation follows today a fixed emission schedule. The current inflation rate is around 4.6% annualized. Here in this chart, you can see that inflation has gone up a little bit in the past month. The reason for that is because SIMD-96 was activated. For those who don't know, just a quick refresher, SIMD-96 removed the burn from the priority fee. And so what that means is that right now, when there's a surge in on-chain activity, there's no burn on the priority fee, and hence you cannot offset that issuance as you can see, like during the Trump meme coin launch around January 20, you saw a huge spike in the burn rate, and that kind of offsets the volatility. But that's not the case anymore because there's just not burn anymore. So with this in mind, like attention shifted toward SIMD-228, and there's a sense of urgency by some people in the community that says that inflation is too high right now, and Solana is basically overpaying for the security. So I think we have right now, I think we have in the slides an image of the curve. If we could show it, that would be awesome. So we have moved like what SIMD-228 proposes is essentially a static curve, like yeah, exactly this one, based on the staking participation rate. And so the idea of this curve is to increase its aggressiveness once the staking participation rate drops below 50%, so that the new inflation rate proposed by SIMD-228 surpasses the fixed emission schedule once the staking participation rate drops below 33%, which is like this, like where the black line crosses with the purple line. And the idea of this is just to increase the security in case there's a huge drop in the stake, which is not expected, but is a good mechanism. So with a current staking participation rate of around 63%, Sol's inflation rate will drop to about 0.96% under SIMD-228, which is obviously a big drop from the 4.6% that we were discussing previously. And this has sparked some big debate in the Solana community. There have been huge conversations going up in recent weeks. I'm sure people have seen them. But basically, the idea is that SIMD-228 can reduce the profitability of Solana validators significantly, especially small validators, and thus it could reduce the validator count. The reason for this is that today, the biggest cost for being a validator on Solana is voting costs, which is a recurring cost, and is around $60,000 per month. And so some validators already run like on thin margins. And if SIMD-228 reduces like their like a huge portion of the revenue, then they could become unprofitable and drop off. Helios drew some estimates around what that number could look like, and the current estimate is around like 3% of the validator count could drop off, which, to be honest, is not that big of a concern. And then the other point against SIMD-228, which I think it's more present, is the one made by Lily Liu of the Solana Foundation. And she mentions that it's a mistake to change Solana's inflation at a time of peak institutional interest just before ETFs potentially go live this year. And the reason for that, and I think it's an underappreciated point, is that Sol inflation sort of subsidizes institutional distribution today, where if you look at custodians, ETP issuers in Europe, they don't actually have exposure to the underlying asset, which is Sol, but they do benefit from Sol inflation. So other things equal, they prefer having a higher nominal staking yield, and they don't really care where it comes from, than having like a lower yield, but it's just based on like real revenue. And like, just think about it like from an example, like think about a staking ETP in Europe, and the ETP issuer takes a portion of the staking rate. Um, Other things equal, like inflation being so high today benefits them because they get a higher percentage of the staking yield, and they have higher revenues. Thus, they have like an incentive to sell Sol to their clients. And the same goes for custodians and other types of like institutional players. And so, if you remove that inflation, there could be like this risk where some of these institutional players lose interest like in promoting Sol to their clients. And so the idea of Lily is that Sol could actually lose some institutional interest after SIMD-228. I don't necessarily agree with this stake, but it's obviously, I think it's the strongest like argument against implementing SIMD-228.
Yeah, I pulled up the list of validators by stake, and to the point, you can see Binance staking Coinbase, Ledger by Figment, and Figment themselves, and Galaxy as well. They all have commission rates of 5 to 8%, and obviously very large amounts of stake today, which, like you would expect, is from customers using their services and depositing their assets and staking them via that custodian. Um, so yeah, I think it just drives home the point of maybe the potential value there.
Yeah, I think
Yeah, absolutely.
funny thing is, Carlos, we both came from separate European ETF and ETP issuers, so we kind of like live this industry for a little bit. And yeah, I know you don't necessarily agree, and I don't think I agree either. I mean, they still have staked ETH, even though ETH was like 3% at one point. I mean, they're still going to offer these products because AUM is just more revenue on their table for them. I mean, even if they have to charge a management fee, I mean, look at Bitcoin or Ethereum ETFs in the US right now, or even Bitcoin ETPs in Europe. There's a management fee there, and they're one of the more popular products. So I really think the demand side is more important than what issuers do for marketing and whatnot. I mean, Bitcoin, I mean, BlackRock can help market Bitcoin a lot, but I think like Solana can market itself. And I think investors, retail or institutional, want a coin with a good story, and possibly a low inflation helps that story, as it's helped Bitcoin in its past, as Ethereans have tried to use with their disinflationary fee model. So I think the demand side is more important than that, and I think you agree with that too. And but I wanted to ask, we're on the voting now. I think it has like just over 8 hours left. What do you think the outcome is going to be?
Yeah, like absolutely. I think we can share like the live voting, but just before that, one point that I want to like drive home is like you mentioned like the ETPs in Europe. Like
Mm,
I think one of Lily's arguments here is like if you look at Sol ETPs, like the Sol ETP, at least where I was, it was the biggest, like it was the highest ETP by assets under management, even higher than Bitcoin. And so she kind of uses this argument like one of the reasons Sol ETPs have gotten so big in Europe, like even higher than Bitcoin, is because of this like staking yield that they get on top of the underlying exposure. And so other things equal, like if you have like a staking ETH ETP and a staking Sol ETP, and the issuer makes more money on the Sol ETP, then obviously they have like an underlying incentive to sell you the Sol ETP over the ETH ETP. So I think that's one of the points like Lily was making, which again, I agree with you, like demand is more important, but I think it's also like crucial to understand the other side of the argument. And like just looking at this vote status, like voting ends at epoch 755, that's about 60 hours from now. So right now we're at epoch 754. It has about 8 hours left, and then we have like 2 days left from epoch 755. We have not yet reached the quorum required for the vote to pass. About 28% of active validators have voted. We need more than 33% of validators to vote for SIMD-228 to pass. And if we meet a quorum, like it's likely that SIMD-228 passes, because you see that from the validators that have voted, there is a majority of yes, but we'll need to wait basically around 2 days to see like what the outcome of the vote is. Below, we see SIMD-123. It's being voted in the same time frame. We see a more favorable opinion here. Again, we have not reached quorum. It's only at 23%. We need more than 33% for that to pass. For those who don't know, just quickly, SIMD-123 is just like the block revenue distribution proposal. So right now, if you're a validator, you get set a commission rate for issuance rewards, but you cannot share priority fees with your stakers. So what SIMD-123 would do is it allows validators to share priority fees with stakers natively. And so obviously an important proposal as well for aligning validators with stakers.
I don't want to call either of these things early, but it has seemed like the broader community sentiment around, at least around 228, has been largely positive from what I've seen, or at least in favor of the proposal. Like you've mentioned, Lily seemed to be the largest and loudest voice on the opposite end, in the against camp. But I think we've seen broadly the community has been in favor of, so it would not be surprising to see this pass with a yes. I guess going forward, the combination of these two things, are there other like additional proposals in the future around the staking rate or other changes to the network that we expect to come into the future and kind of play into these dynamics as well, Carlos?
Yes, there are future proposals that I think are relevant to discuss. I think the reason like just CMD-228 was so controversial is that it is one of the first changes that I can think of that is not just purely technical, but it's also very economic in nature. And most of the proposals that we have seen those far are very engineered focus, where it's just like, let's solve this bug in the protocol, let's make this more efficient. Whereas here, it's yes, it's somewhat related to like, it's technical, of course, but it's also very economical, and it like it has this side of what is the implication on solve the asset and on the flows that it could generate, which core devs, I mean, they are brilliant in Solana, but they are not so in touch like with the institutional side of things, which I think was one of like Lily's points. And so in terms of like future proposal, there's a proposal to increase the block limit on Solana. So basically the block size to 60 million CUs, I think. And so right now there's like Solana's slogan is basically increase bandwidth, reduce latency, right? So right now, devs are trying to increase the block size gradually to eventually double it, potentially this year, and that would increase bandwidth. And so I asked one of the core people at ANSA if there was also like plans to reduce latency, that is reduce load times below like the 400 milliseconds. And other things equal, I think they prefer reducing latency over increasing like bandwidth. So reducing slot times over doubling block size. But the problem is that this has more complex implications around the validator ecosystem. And one of the things is that if you reduce the slot time to, let's say, from 400 milliseconds to 200 milliseconds, you would double the amount of votes necessary for validators, essentially. And so validators with votings being the biggest cost, that would increase like cost by a lot for validators. So you need to do other things before you're able to like push these boundaries of performance, such as like abstracting away voting cost or reducing them, or like, yeah, so just a bunch of things that it has downstream implication on a lot of things that you need to think about before doing that.
How do the like potential increases to like the CU limit for blocks, as well as, you know, if we were to actually get to a point in the future where they could alleviate some of the voting costs and reduce, you know, the time for blocks as well, like the expected additional requirements for validators, for example, like on this CU change, for example, do we expect most validators to basically be able to just turn that on and be good to go, or is there an expectation of a need to like raise the general requirement of like capabilities of a validating node?
So right now the CU limit increases are very, very conservative to the extent that it really doesn't have any effect like on the network performance at large. And the reason they're doing it that way is because, just for the reasons you mentioned, they want to make sure that there are no like unexpected consequences in terms of like validators. Maybe some validators have hard coded some like assumptions. So they just want to make sure that there are no like unexpected changes, and they are doing it gradually so that they can eventually double and make sure that no validator like will suffer or be subjected to like yeah, any kind of like negative impact. uh, in terms of reducing slot times, it's a lot harder to do, and it's not just voting costs. Like, imagine, for instance, you have to push the limits of consensus to the point like how fast can you propagate like information in the network and make sure like every validator is in line to like be able to have that information in like 200 milliseconds or 50 milliseconds. And so yeah, that's a lot. That's a problem that's a lot more challenging, but the rewards are also a lot higher.
Yeah, I guess the culture in Solana has been very differentiated, I would say, from that of Ethereum, but it would not be surprising to continue down this road where increased requirements, increased, you know, throughput, reduced latency, IBRL, lead to generally increased like capabilities and requirements out of validators, and where maybe at some point we get back to the discussion of like how decentralized, how centralized is to one way or the other. I think the ETH camp has been boldly in the camp of like not wanting to raise any requirements for a long time, keeping things very simple for the like at home solo staker. I think that's really not been the case for Solana, but who knows if, you know, if the goal is really to just kind of keep shipping and increasing the capabilities of the network. That might become a conversation at some point in the future as well, if, you know, significant numbers of validators have to drop out, basically.
To be honest, I kind of prefer Solana's approach right now, like not letting, call it the weakest links to hold back the entire chain. But even in that same vein, we saw Ethereum increase their gas limit by 20% this year. The 60 million compute units increase. Would this be the first increase, like let's call it block increase in like 2
Is
years?
the No, it would be the second. We had an increase in, I want to say, January, but yeah,
Okay.
like 2 months ago or 3 months ago.
Okay, yeah, I like this trend, and I think Solana's been on the path of performance first, and then we can figure out decentralization a little bit later. However, you want to measure that, and I think it's above things like Aptos and Sui that uses BFT consensus, which has like you're limited to like 1 to 200 validators there, so it's miles ahead of that. But yeah.
Yep. Great points. And great coverage. Thank you, Carlos, for the deep dive on 228. Have you been getting silly on chain this year, farming on 10 plus wallets across different ecosystems? Well, CryptoTaxCalculator is here to help. CryptoTaxCalculator has 3,000 plus integrations to support all of your wallets, exchange accounts, and on-chain activity, and a custom pricing oracle to handle even the most chaotic portfolios. Get started today and make tax season easy. You can use our exclusive discount code BW2025 to enjoy 30% off all paid CTC plans until April 15th of this year.
Follow the link in the show notes below to get started.
I think maybe one last topic, because there's been a lot of discussion, and I think we've kind of alluded it to a little bit in recent calls and even today, around this like continued trend towards maybe TradFi adoption of potentially crypto rails. This idea that like RWAs is a bit of a hot topic today, real world asset protocols. I just wanted to share one chart from our friends at DeFi Llama with some data from their narratives tracker. But we can see here that purple line is the AI category and the orange line is the RWA category. So it's interesting to see how quickly this market shifts between from one narrative to the next. AI was very much the hot topic in late 24 going into 2025. And, maybe partially spurred on by the new administration and, easing regulations, et cetera, et cetera. This concept of like RWA protocols, RWA tokens are maybe hot in everyone's mind now. I guess the sort of lingering question here from me is it getting a little bit disconnected from reality? Do people really have like reality and expectations set correctly around real world asset protocols? I think it calls back to some conversations around, if some of these large institutions are going to come in, do we really expect these like open source and kind of like freely available technologies that have been built out to accrue to, the DAO protocol tokens sitting around those? Or is it going to be, the BlackRocks that come in, adopt the tech, build it with their own staff, with their own servers, what have you, spit out their own chain. And we see the value basically just accrue to them in the form of, captured revenues or something of the like. I guess I'm curious your guys' thoughts. Like, are there names or protocols in the RWA space that we're genuinely excited about, and we're not so concerned about like a sort of a capture of this space from the entering participants?
I think it's going to be tough for DAOs like incumbent. Upcoming protocols that come and really capture the RWA profits. I think it's going to be existing TradFi markets, because that's where trillions of the assets already are, right? And if you look at it now, it's real world assets are growing. The most popular one is stable coins, but we don't really bucket that into it. But real world assets have been growing, but albeit slowly. I know RWA.xyz keeps track of all the assets on the different chains, but I think I don't see how you can trade these things without not being in a KYC manner. So because these things already have existing regulations around them, they aren't just some kind of meme coin that's spun up. I think there's going to be two paths for it. There's going to be like BlackRock has their own version of Ondo, and they start to build up stuff, or like Providence, for example. And on here we see RWA.xyz. They have this chart to show you the different private assets by category. And if we look at that private credit, that in the blue line, by far the most massive, and all of that is coming from one chain, that's Providence blockchain. And it's mostly private credit from HELOCs, which is like home credit loans, basically. Think of it like mini mortgages. And, so they already tapped into the crypto markets, the blockchain markets, with existing traditional financial instruments. And they're also issuing some of this stuff directly on chain, using like certain tokenization standards that have been around for a while. It's just that like Providence has adopted them first and integrated it into the chain. And I think what's interesting about them too is that they aren't a fully permissionless chain, in the sense that it is permissionless to run a validator, but in order to bring in new opcodes, you need a quorum of the existing validators to agree on bringing in those opcodes, or you can call them contracts. The existing contracts are all financial based. You can build your derivatives and dexes and other things as well, but the reason why they did that was to prevent, meme coins or certain kind of NFTs with royalties from flooding up the chain. And they wanted to be, and in my opinion, this is probably the closest thing to an app chain that there is, because in any other app chain, you can just build whatever you want, but this one has some kind of limitations on that. So I think that seems to be the most successful way to do it if we only measure things by TVL of RWA. I think another way, which is also likely, is permissioned chains, or in my opinion, maybe permissioned L2s. And I say L2s because as these large institutions, it's probably easier to just use the EVM because there's so much documentation there. It's probably easier to get a developer. AI can probably help you with it as well, given the resources. And you can have full control over your environment through that centralized sequencer. So it just seems, and there's, RAS providers as well. So it just seems like the lowest hanging fruit for them versus if they were to spin up their own chain. JP Morgan has their own chain, but that's a specialized chain. If they spin up their own chain, then what becomes the point? Because then every large institution has their own silo chains, and then you basically, what benefits are you getting? You might as well have kept it on your traditional database in the first place. So unless traditional financial institutions have some standard that they come together and agree on, which is not, that's something that they do all the time, and especially in the financial sector, but maybe not something with such an emerging technology, not so early. So more likely they will go to interop solutions that already exist in the open source space. And if layer twos can figure out that interop, I see that as just the lowest hanging fruit for them to have, quote unquote, the best of both worlds.
How do you think about the limitation of like Ethereum L2s today from like a throughput perspective? Because I think it kind of calls back to your point about, if there's not really much of an advantage or a benefit, like why not just keep it on your private server? And with most L2, like Base is really the only example that's trying to really push and scale throughput, but the majority of them still sit at sort of like the ETH standard of doing like 10 to 20 TPS, which I'm imagining, like, if we're thinking about some of these very large financial institutions, like the amount of money and the amount of customers that they have and the amount of maybe transition of asset or like movement of assets that they might be dealing with, there might be an expectation of being able to handle higher throughput. I don't know if that puts pressure on this EVM idea, or just, they're all going to be adopters of like Reth, for example, and really just scale the heck out of a sequencer like Base is doing.
Yeah, that's a really good question. I mean, I think initially pilot programs, I think, move these RWAs don't really move as much as we think they do. Like things that really move are like treasury markets, like very liquid, very short-term instruments, and those aren't going to be put on chain. There's no point. They already work fine. I think it's slower moving things like private credit or private equity. These, and you don't need as high of a throughput for it. So maybe there's a scenario where, 10, 20, 50, 25, 50 TPS is fine for the current use case. And as they start to, as these things become on chain, and now it opens them to becoming more traded more frequently, and then you might need more throughput. So it can grow as adoption grows. Maybe the backend infrastructure grows with it as well, but in the early days, this might not be as necessary. Or you can do, provenance 20, like how much of a validator is relatively smaller node set, and just beef up the requirements. You have IBC if you really want to have some kind of interrupt. But then but again, it really depends on what standard they go around. And I don't think they are going to, when they're doing this analysis, I don't think they're going to jump to that level of it. I think it's going to start off with pilot projects, as you always have to do. And I think the easiest pilot project is EVM, and then unless you really start to see the benefits and hire a proper team to build it out, and maybe they say, oh, we should do this on, maybe we should look for a faster chain or something else, depending on what your criteria are. I think probably L2s or well, I think probably L2s will just be the way, or something EVM related will probably be the way.
Yeah, I agree with that. L2s just allow for a faster time to market. You don't have to worry about like building consensus, bootstrapping a validator set in case like you want it to be like your own chain. It just makes sense to build an L2. There's also like Avalanche subnets that were specifically focused on like institutional players. I think that's something like we could keep an eye on. There's also this interesting thing about, like Mark mentioned, like standardization. Like there are some ERC20 standards like are specific for like for permissioned kind of things, like allow for blacklisting and that kind of stuff. You also have like token extensions on Solana, which like the main focus was to allow institutions to enter the chain, like with private transfers, control over who gets to control like the token and whatnot. So I think like we're seeing a push from many ecosystems to onboard RWAs on their chain. And with that, like it's obvious why, because it can unlock like a huge amount of like TVL and distribution. But like, yeah, I think it's very early stage. I honestly think the main issue today is not technological, but rather regulatory, and many of these like institutional players just don't know what's the right way to do it. And if you onboard like an RWA on chain, there's also this issue of how do you have legal like like a legal claim on the on-chain instrument where when you trade it like off chain, because like these items like are usually like issued off chain first. So you need to make sure there's like a legal way for like when you transfer ownership of that asset on chain, there's also a way to do it like on an off chain basis, if that makes sense. And so like one of the things that I'm excited about is just like issue things directly on chain, because it makes things a lot easier than just like having these like a hybrid system where you have like a traditional rails and on top of that you tokenize things. I think that adds a lot of friction and you lose a lot of the benefits of blockchain technology that way.
Great points. It is interesting to see the continued drive in a lot of the newer chains, at least towards like, I mean, this increased bandwidth, reduced latency seems to be the motto for most of like the cutting edge teams at this point. You know, the Monads, the Mega ETHs, you know, there's Fogo, there's Unto, there's a bunch of different chains. Even Sui and Aptos, I think, is really the same ideology there. And I think interesting to hear a contrast here when we think about institutions wanting to bring RWAs on chain and maybe that not really being their consideration today. But you know, this could be a little bit of a difference in terms of timelines and expectations of like where things are going. Obviously, Solana has a need to like service their retail traders today, whereas the distant future of like on-chain institutional usage is not quite here yet. So different needs for different times, I guess, is maybe the one big takeaway there at the moment. But I think we're still early to a lot of this stuff, and I think the point around regulations is key. You know, I think we're still looking like, at least in the U.S., we're waiting for stablecoin bill. We're waiting for clarification around a market structure bill, probably various other things that might impact, whether banks might even be allowed to custody different cryptocurrencies. A lot of different things that aren't in place yet that are sort of keeping any kind of interested parties sort of held back from doing anything right at this moment. But since I have both you guys here and you're both going to be in DAS next week, maybe to close off the episode this week, I'd just be curious to hear from you guys, like either the guest or speaker you're most excited to hear from at DAS next week, or a talk or any event that you'll be taking part in while you're there next week.
I'm excited to hear Ryan Connor's panel on like valuation. I think that would be interesting.
Yeah, I mean, I'm looking forward to what I'm involved in. I'm moderating on Bitcoin centralized lending, and then one on Marinade staking. And definitely think I should come and check it out. I'll also be emceeing on the first day for the investor track, so it's going to be a fun time all around.
Awesome. Shameless shill for Mark. Definitely, if you haven't already, if you're interested, if you want to head to DAS, it is next week. Like I've said, this is sort of like the last chance to grab your tickets. 0x10 is the code if you want to get 10% off tickets at the link in the description. Go see Mark. He'll be, like he said, he'll be emceeing. He'll be doing a few things. Cash Flows Connor will be talking about valuations of things, as would be expected from a man that goes by Cash Flows Connors. So we will see you all next week, either at DAS or on the next pod. Thanks for coming on, guys, and we'll see you all next time.